This LOS is describe how legal, regulatory, and tax considerations affect the issuance and trading of fixed income securities. Legal and regulatory considerations. The global bond markets consist of national bond markets and the Eurobond market. A national bond market includes all the bonds that are issued and traded in a specific country and denominated in the currency of that country. Bonds issued by entities that are incorporated in that country are called domestic bonds, whereas bonds issued by entities that are incorporated in another country are called foreign bonds. Foreign bonds very often receive nicknames: Bulldog bonds in the United Kingdom and Yankee bonds in the United States. Eurobonds are typically less regulated than domestic and foreign bonds because they are issued outside the jurisdiction of any single country. They are usually unsecured bonds and can be denominated in any currency, including the issuer's domestic currency. Quick practice question. A South African company issues bonds denominated in pounds sterling that are sold to investors in the United Kingdom. These bonds can be best described as A, Eurobonds, B, global bonds, or C, foreign bonds. Okay, these questions are a little bit tricky. You need to practice them a lot just to get all the terms right. So C is correct. Bonds sold in a country and denominated in that country's currency by an entity from another country are referred to as foreign bonds. A is incorrect because Eurobonds are bonds issued outside the jurisdiction of any single country. And B is incorrect because global bonds are issued in the Eurobond market and at least one domestic currency simultaneously. Another quick practice question. Relative to domestic and foreign bonds, Eurobonds are most likely to be A, bearer bonds, B, registered bonds, or C, subject to greater regulation. A is correct. Eurobonds are typically issued as bearer bonds, i.e. bonds for which the trustee does not keep records of ownership. In contrast, domestic and foreign bonds are typically registered bonds for which ownership is recorded by either name or serial number. B is incorrect because Eurobonds are typically issued as bearer bonds, not registered bonds. C is incorrect because Eurobonds are typically subject to lower, not greater regulation than domestic and foreign bonds. Now we're moving on to tax considerations. Generally speaking, the income portion of a bond investment is taxed at the ordinary income tax rate, which is typically the same tax rate that an individual would pay on wage or salary income. Tax-exempt securities are the exception to this rule. For example, interest income received by holders of local government bonds, called municipal bonds in the United States, is often exempt from federal income tax and from the income tax of the state in which the bonds are issued. In addition to earnings from interest, a bond investment may also generate a capital gain or loss. That's if it is sold before its maturity date. The price is likely to have changed compared with the purchase price. This change will generate a capital gain if the bond price is increased, or a capital loss if the bond price is decreased. From the standpoint of taxes, a capital gain or loss is usually treated differently from taxable income. If a bond is purchased at par and held to maturity, there is no capital gain or loss. One last practice question to finish this LOS. An investor in a country with an original issue discount tax provision purchases a 20-year zero-coupon bond at a deep discount to par value. The investor plans to hold the bond until the maturity date. The investor will most likely report A, a capital gain at maturity, B, a tax deduction in the year the bond is purchased, or C, taxable income from the bond every year until maturity. I like this question and it makes sense, and we've seen part of it in the accounting in previous LOS. Anyhow, C is correct. The original issue discount tax provision requires the investor to include a prorated portion of the original issue discount in his taxable income every year until maturity. The original issue discount is equal to the difference between the bond's par value and the original purchase price. A is incorrect because the original issue discount tax provision allows the investor to increase his cost basis in the bond so that when the bond matures, he faces no capital gain or loss. B is incorrect because the original issue discount tax provision does not require any tax deduction in the year the bond is purchased or afterwards. And that's the last slide for this LOS. Thank you.